Welcome to the deep dive. We're doing something a little different today, and I'm so excited to dive into this new material with you.
Yes. It looks like we're going deep into the world of behavioral finance.
Behavioral finance, have you heard of this?
Oh, absolutely. It's a fascinating field.
It really is. So we've got some excerpts here from behavioral finance. The Second Generation
I'm your Statman.
by Meir Statman.
He's a leading researcher in the field.
Yeah, and don't let that second generation part scare you away.
Not at all.
It's actually super interesting and very readable.
He's really great at explaining those complex concepts in a way that, just makes sense. And he uses so many real-world examples and anecdotes that you'll find yourself saying, oh, I've totally done that.
Totally. So to kick things off, let's talk about standard finance.
Okay.
You know, that world of perfectly rational investors who always make the most logical decisions to maximize their wealth.
Right. Always maximize.
Always maximize, and that's the goal.
That's the classic economic theory.
But does that really reflect how we behave in the real world?
Well, in theory, it sounds good.
Yeah.
But in practice, not so much.
Not so much.
I mean, think about it. Have you ever bought something you didn't really need?
Oh, all the time.
Like those shoes that are still sitting in the box?
Or that gadget that you used once and it's now in the back of your drawer.
Exactly. Those aren't exactly rational, wealth-maximizing decisions, are they?
Definitely not.
And that's where behavioral finance comes in.
Okay.
It acknowledges that we're human.
Yes.
We have emotions, we have biases.
We make mistakes.
We make mistakes, and that's okay. Behavioral finance helps us understand those human elements in our financial decision-making.
So it's not just about calling people irrational.
No, not at all.
It's about understanding what drives our choices.
Right. Exactly. Statman talks about these different wants that we have.
Okay, wants, tell me more.
So you've got your utilitarian wants, which are all about, practical value, maximizing wealth, like that classic rational investor we talked about.
Right, the standard finance person.
Exactly.
Right.
But then you have expressive wants, which are more about our values, our identity, how we want to be seen in the world.
I see. So like someone who chooses to invest in sustainable companies, even if it means maybe a little less return.
Exactly. That's an expressive want at play.
Okay, that makes sense. And then, of course, there are the emotional wants.
Oh, yes.
Driven by our feelings,
Yeah.
Like the excitement of buying a lottery ticket or the fear that makes us sell all our stocks when the market dips.
We've all been there.
Oh, absolutely. So we've got all these different wants swirling around in our heads, and we have to make decisions.
Right. And to navigate that, we use mental shortcuts.
Mental shortcuts. Okay, interesting.
Or what Statman calls heuristics.
Heuristics. I like that.
These shortcuts can be really helpful in everyday life.
Yeah, I could see that.
They save us time and energy, allow us to make quick decisions without overthinking everything.
But sometimes those shortcuts can lead us astray.
Sometimes. Especially when it comes to finances.
Okay. Give me an example.
Well, think about the lottery ticket.
Okay, the lottery.
From a purely rational perspective,
Yeah,
buying a lottery ticket is a terrible investment.
yeah. The odds are.
The odds are astronomically small, yet millions of people buy them every week. Why is that?
Because we're dreaming.
It's more than just the chance of winning millions. It's about the feeling.
Yeah, that hope.
That hope, that possibility. It's exciting. And it's also an expressive act.
What do you mean?
It's like saying, I'm a player, I'm in the game.
Right.
Even if the odds are slim.
So it's not just about cold, hard logic.
Yep.
It's about the emotional and expressive benefits
Exactly.
that come with that little piece of paper. Now, have you ever bought a lottery ticket? What motivated you?
Maybe that's a story for another time.
Okay, fair enough. But I think that example perfectly illustrates how those mental shortcuts can be helpful. But they can also sometimes lead us to make decisions.
That might not align with our long-term financial goals.
Exactly. So it's like we're on autopilot.
Yeah.
Relying on our gut feelings and those ingrained shortcuts.
Right.
And we end up making choices that maybe we regret later.
It happens.
So how do we break free from those patterns? How do we become more aware of those forces that are secretly shaping our financial decisions?
That's the million-dollar question, and that's what we're going to dive into next.
Stay with us. We'll be right back after a quick break.
So let's talk about some of those biases. Statman dives into this whole world of cognitive and emotional errors, these sneaky biases that can trip us up.
Okay, sneaky biases.
Without us even realizing it.
Yeah.
And understanding these is really the first step towards making better decisions.
So give me the rundown. What are some of the common traps that we need to watch out for?
Well, there's framing for starters.
Framing, okay.
It's how the way information is presented can actually influence our choices.
Oh, I see, I see.
It's like those buy one, get one free deals.
Oh, yeah, yeah.
Are you really saving money, or are you just buying more than you need?
Right, right. It's all about making it sound like a deal, even if it's not.
Exactly. Or how some life insurance companies will label their premiums as assurance instead of a loss.
Ooh, that's good. That's a good one.
It just feels more positive.
Much more positive.
The framing subtly nudges us in a particular direction.
Interesting.
And there's hindsight bias.
Hindsight bias.
Like, I knew it all along feeling.
Yeah.
We tend to overestimate our ability to predict events after they've happened.
Oh, we all have that friend,
Yeah.
who claims they predicted the latest market crash.
Oh, absolutely.
Or the tech boom or whatever.
Yeah, but as Statman points out,
Yeah.
even Warren Buffett questioned his partners who said they saw the market decline coming.
Really?
It's easy to connect the dots looking back, right?
Yeah.
But predicting the future, whole different ballgame. And speaking of selective memory, there's confirmation bias.
Confirmation.
Where we seek out information that confirms our existing beliefs
Right.
and conveniently ignore anything that challenges them.
So it's like when you're convinced that a certain stock is going to take off
Right.
and you only pay attention to the positive news, you ignore all the red flags.
Exactly. Statman uses the example of the bearish sentiment index, which some investors swear by. And even with evidence suggesting it's not really a reliable predictor,
Yeah.
they'll focus on the times it worked and dismiss the times it didn't.
They're cherry picking.
Exactly. It's a powerful bias.
Wow.
Then we've got anchoring and adjustment.
Anchoring.
Yeah, it's our tendency to get fixated on an initial piece of information
Okay.
and then adjust our thinking from there, often not enough.
Oh, interesting. Like what?
Like when you see the asking price of a house, it kind of becomes an anchor in your mind.
Yeah,
It influences how you perceive its value, even if there's evidence suggesting it's overpriced.
Right. You get stuck on that number.
Exactly. Or how about when a stock price drops significantly, you might be tempted to buy it thinking, oh, it's a bargain.
Yeah.
But the drop could be completely justified.
Right.
We get anchored to that initial price.
Fascinating.
And last but not least, there's representativeness.
Representativeness.
Where we over-rely on stereotypes or past patterns to make judgments about the future.
So like assuming that the next Uber or Airbnb is guaranteed to be a success just because it's, similar to past winners.
Exactly. Remember all those .com companies back in the day?
Oh, yeah.
Everyone thought they were going to be the next big thing.
Right, right.
But a lot of them crashed and burned.
That's a good point. It's easy to see patterns where none exist.
Absolutely.
Okay, so we've covered these cognitive errors, these biases.
Right.
But we can't forget about our emotions.
Oh, absolutely not. Emotions play a huge role.
They really do.
Fear and hope, for instance, can lead us to make some pretty impulsive choices.
Oh, tell me about it.
When fear takes over, you see those panic selling during market crashes.
Oh, yeah.
And when hope is running high, you get those speculative bubbles.
The bubbles.
Fueled by the belief that the good times will never end.
Yeah, it's a roller coaster ride for sure.
It is. It is. And then you have regret and pride.
Ah, okay. How do those come into play?
Statman calls this the disposition effect.
Disposition effect.
It's the tendency to hold on to losing investments.
To avoid the regret.
To avoid that regret of admitting a mistake, yeah.
Okay.
But quickly selling winners to lock in gains and feel good about ourselves.
Oh, interesting. So it's almost like we're more motivated by avoiding pain
Then maximizing profit.
than maximizing profit.
Yeah.
It's a good point. And then there's trust.
Ah,
Or the lack of it.
right. Think about Ponzi schemes.
Yeah, those erode trust.
Not only in the people who run them,
But in the whole system.
yeah, and it can lead people to pull out of the market altogether.
Right. It's a big deal.
It really is.
It really highlights how interconnected we all are.
Next.
We're influenced by the news, by social trends, by what our friends and family are doing, even our own gut feelings.
So with all these cognitive and emotional biases at play,
Yeah, lurking in the shadows.
how do we make better, more informed financial decisions?
That is the question.
Well, Statman says knowledge is power.
Okay, knowledge.
We need to understand both the financial facts
Right.
and the human behavior element.
So it's not enough to just crunch numbers and look at market trends.
It's not enough.
We need to understand ourselves.
We need to understand our own psychology.
Our wants and our shortcuts.
Exactly. Those things that are shaping our choices.
Okay, I'm with you. So how do we put this knowledge into practice? How do we start making better decisions?
He actually offers a 3-step process
3 steps, okay.
for correcting errors.
Give them to me.
First, acquire knowledge,
Knowledge, okay.
both financial facts and human behavior knowledge.
Got it.
Second, activate reflection.
Reflection.
Engage your critical thinking skills, really evaluate your decisions.
Okay, so not just going with your gut.
Not just your gut, no.
Think it through.
Exactly. And third, seek outside help when needed.
Okay, so like a financial advisor.
A financial advisor, a therapist.
Someone who can give you a different perspective.
Exactly. Someone who can help you see past those biases.
But even professionals are susceptible to these biases, right?
No, absolutely.
No one is immune.
No one is immune. We're all human.
We're all human. But recognizing these patterns,
Yes,
understanding our wants and those shortcuts,
it's a big step.
it's a big step towards making decisions, for sure.
It really is.
So how does this all play out in the way we actually build our portfolios? I'm really curious about this idea of behavioral portfolios you mentioned.
Yeah, behavioral portfolios.
It sounds like a much more realistic approach than just focusing on, maximizing returns and minimizing risk.
It is. It takes into account those expressive and emotional wants.
Right, those wants we were talking about.
Exactly. Statman uses a pyramid analogy to illustrate this.
Oh, a pyramid. Okay, I like analogies. Tell me more.
So at the base of the pyramid,
Okay, the base.
you have protection from poverty.
Protection, that's the foundation.
The foundation, exactly.
Yeah.
This layer is all about security, stability.
Okay, like your safety net?
Your financial safety net, exactly. It includes things like an emergency fund, insurance, maybe some conservative investments.
Makes sense. Everyone needs that security before they can think about anything else.
Absolutely.
So what comes next? What are those middle layers of the pyramid all about?
So those middle layers represent specific goals that are important to you.
Goals, okay.
Like saving for your kids' education.
Yeah.
Down payment on a house.
Retirement.
Retirement, travel, maybe starting your own business.
Oh, it's like building blocks. Each layer supporting the one above it.
That's a great way to put it.
And I'm guessing the top of the pyramid is where things get a little more exciting.
You got it. That's the prospects for riches layer.
Riches. Okay, tell me more.
This is where you might find higher risk investments.
Okay, higher risk, yeah.
Things with potential for big gains.
And also bigger losses.
But also bigger losses, right. It's where you might dabble in those speculative stocks or that new cryptocurrency everyone's buzzing about.
So it's not just a random collection of assets.
Not at all.
It's really a reflection of your own individual wants and priorities.
Exactly.
Built layer by layer.
Layer by layer.
I love it.
And it gets even more interesting.
More interesting. Okay, lay it on me.
Because our behavioral portfolios, they evolve as we go through different life stages.
Oh, that makes sense.
Statman calls this behavioral life cycle theory.
Behavioral life cycle theory. So like how our needs and goals change over time.
Exactly. It reminds me of that story in the book about the woman who inherited money from her husband.
Oh, yeah.
He had spent his life, accumulating wealth.
Yeah.
But he hadn't actually taken the time to enjoy it.
It was a wake-up call for her.
It was. She realized that sometimes we get so caught up in saving for the future that we forget to live in the present.
That's so true. So she decided to travel.
She did. She decided to prioritize those travel dreams while she was still young and healthy enough to enjoy them.
Good for her. It's a good reminder that our goals and priorities can change, and our portfolios should reflect those changes.
Absolutely.
Okay, so we've talked a lot about individual investors.
Right.
But how does behavioral finance apply to the market as a whole? What happens when you have thousands, even millions of investors with all their own biases and quirks?
Well, that's where behavioral asset pricing comes in.
Behavioral asset pricing, okay?
It looks at how psychological factors can actually influence market prices and returns.
Wow.
Okay. For example, have you noticed how companies are really focusing on those ESG factors these days?
ESG, yeah. Environmental, social, governance.
Exactly. It seems like every company is touting their sustainability initiatives and social impact.
It's everywhere.
That's because investors are really starting to factor those elements into their decisions.
So they're not just looking at the bottom line anymore.
Not just the bottom line, no. They may
Aware. Okay.
of your own behavioral patterns.
Our wants, our shortcuts, those potential errors.
Exactly. It's about self-awareness, reflection, and making conscious choices that truly align with your goals and values.
So well said. Now that you've had a glimpse into the world of behavioral finance, I encourage you to think about your own financial journey. What are your wants? What shortcuts are you using? Are they helping you or holding you back? Remember, knowledge is power. By understanding the forces that shape our financial decisions, we can all take control and make smarter choices.
Wow.
Thanks for joining us on this deep dive into the fascinating world of behavioral finance.